Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our IFRS 4 Phase 2 update. The title of today's webcast is ISB continues its redeliberations, decisions on insurance contracts revenue and other issues requiring further analysis. As always, our webcast is structured around three agenda items, with the highlights of the decisions from the ISB meeting first, followed by the ISB staff recommendations and board discussions, which will represent the majority of the time allocated for the webcast. I will then spend a few minutes at the end to talk to you about the next steps and the Deloitte views on the timetable and its update. Coming to the highlights, there's been a couple of meetings last week. The first one on the 24th, Thursday last week, was an education session to confirm that the ISB continues to maintain the pattern of rehearsing through education sessions the papers that are then discussed in a very short order. In fact, this was the following day for a decision-making session. And indeed, on Friday last week, the ISB tackled another of the five topics that were exposed last June and looked at reaching decisions on insurance contracts revenue. The highlight is that the proposals in the exposure draft have now been confirmed also through the redeliberation phase, and this has been achieved by looking at three components of this new requirement. The first is the introduction of a prohibition to include in the statement of comprehensive income any premium amount that is not consistent with the commonly understood notions of revenue. The second is to make this a requirement for all insurance contracts, and the third is to retain the body of disclosures that were proposed in 2013 exposure draft, which enabled users of financial statements to reconcile revenue with the volume of activity that the insurance company may have carried out during the period. In addition, the ISB has also reached decisions on which other issues that were not subject to questions during the exposure draft period last year would require further analysis and potential decisions in the coming months. In terms of the overview of the discussion, let me just remind you that the education session has been considering a number of examples, and those examples have been a useful prompt to illustrate to the ISB members how the various presentation alternatives would have presented the information in the financial statements. In particular, the impact that the use of premium amounts would have had and how it would have compared with other revenue recognition under IFRS. The ISB has now considered three of the five targeted proposals in the 2013 exposure draft, unlocking of CSM, the OCI solution, and now insurance revenue. All of these decisions have been taken only for the non-participating contracts. When the ISB will be discussing the participating contracts topic, there will be then a period of reassessment of the prior decisions in light of the new participating contract set of decisions to ensure full alignment within the standard. The ISB staff adopted the same technique used in March to put forward their recommendations, and that was by asking a significant question at the start and then putting right away their recommendation against it. So you can see the first question in the green box on the slide, and what the staff recommended here in terms of the alignment with the general notions of revenue is that these should be included as a prohibition in the final IFRS. The arguments against this recommendation analyze both benefits and disadvantages of the proposal. In terms of the benefits, first of all, the staff noted that there will be consistency of revenue information between insurance and non-insurance contracts. This will reduce the risk of misinterpretation by non-specialist users as to what represents revenue from an insurance contract. These will also improve comparability between all types of insurance contracts and non-insurance contracts with customers. And finally, there will be a more understandable format of the financial statements with a simple revenue line and an expense line that should make insurance companies' performance statements more transparent and accessible for non-specialist users. As you can see, the issue of comparability across industry is dominating the staff perception of what the benefits of this prohibition would be. In terms of the disadvantages, two in particular we would like to flag to your attention. The first one is that this insurance contract revenue doesn't provide information about the volume of insurance contracts sold in the period, and therefore it doesn't provide a useful basis for an investor to measure the size of the company, the level of sales that that company has made, and how those sales have grown or not compared to the previous period. Also, in order to achieve this objective of prohibition of presenting premium without having a full alignment with the notions of revenue, there is a requirement to disaggregate any deposit component within the amount that is otherwise classified as revenue. And that is requiring potentially complex calculations and introduction of systems for the separation of these amounts from the underlying movements in the value of the contracts within the balance sheet. Having explained all these advantages and disadvantages, the staff opened the debate and started by commenting that items currently included in the statement of comprehensive income across many jurisdictions as revenue do not represent a consistent measure of revenue. So there is inconsistency. There is inconsistency which is both internal to the insurance accounting practices as well as inconsistency with the principles of IFRS revenue recognition. Many ISB members commented that the presence of these material deposit components in a number of insurance contracts and therefore in the premiums receivable for long-term insurance contracts is the source of that inconsistency, and agree with the staff that the prohibition would address that particular issue. They also contemplated the merit of introducing such prohibition in the final IFRS, given that there are a significant number of contracts, insurance contracts with significant deposit components being currently presented as revenue in the statement of comprehensive income. The debate was quite lively, and it was eventually concluded by a discussion around the assessment of the staff recommendations against the general principles in IS1 and its applications within the wider financial services industry, for example, banks and asset managers. At that point, the chairman called for a vote, and the staff was clearly pleased with the level of persuasion they had achieved in the debate when they saw the vote. 13 board members agreed with their recommendations and only 3 board members disagreed. There is quite a large majority, which is normally indicative of a high likelihood that this tentative decision will remain in the final standard. Building on that, the staff moved to the second part of their proposal on insurance contract revenue and asked whether the requirement should be introduced as a mandatory obligation in the standard. A lot of this discussion we'll see in a moment is predicated around the analysis of the benefits against the cost of implementing. The staff was also prepared to offer a fallback recommendation, and there were in fact 4 alternative approaches that the ISB was invited to consider in the event that they would have decided not to make these requirements compulsory in the final standard. However, for each of these, the staff was prepared to argue a number of disadvantages in terms of comparability, and therefore highlighting to the ISB that these fallback recommendations would have been suboptimal from their point of view. When the debate emerged from this presentation, the staff indicated that the cost of excluding the investment component is a justified burden for insurance companies against the benefit of providing to investors and users at large a much consistent presentation of the revenue amount, given the prominence that this financial figure has received within the investor community. At that point, it's also interesting to observe that one board member vocally disagreed with that assessment, indicating that in his opinion it would be difficult and expensive to separate the deposit component, in other words, this disaggregation process, and that would have created a high cost for a benefit that he was actually questioning would have been commensurate to the effort. In particular, he observed that in his personal view, the summarized margin would have been a preferable alternative. The debate continued, stimulated by this provocation, and it was noted that the separation of the deposit components affected the debate also for other reasons, in that board members noted that if such a requirement was to be introduced, it would need to be applied consistently between premiums as well as benefits and claims, so that both revenue and expenses were consistently presented in the statement of comprehensive income. A number of board members also questioned the approach that these would have been put into the standard on the grounds that it appeared to be very detailed and in their eyes potentially departing from a principle-based approach. The staff and other board members were of different view, and eventually that concern was disregarded by a significant number of board members. As you can see, the vote led to 15 board members agreeing with the staff recommendation, and only one holding his alternative view that these will not be a benefit for the quality of the final standard. The staff then moved to the next question, which was, should we retain the disclosure proposed in the 2013 exposure draft related to volume information? And the recommendation was clearly to include them in the final standard, particularly around four components of the requirements, each delivering a particular objective in terms of enabling an orderly transition from the existing practice, where a number of activity financial information is presented as revenue, and it will not be the case in the future. So the first objective is really to help users understand how the balance sheet has been moving, and highlighting the component that would then be feeding into the P&L presentation. And so paragraph 76 of the 2013 exposure draft would require insurers to reconcile opening and closing balances of the components of the insurance contract assets or liability. And this is to also to remind us that under the new standard, in the balance sheet we have a bundle of rights and obligations being accounted for as a single line by portfolio. But if a portfolio happens to be on the debit side, an asset, that portfolio will be separately reported in the balance sheet as an asset, with all the other portfolios being reported separately as liabilities. And it is the components of these portfolios that need to be reconciled, meaning the expected cash flows, the impact of discount, the risk adjustment, and the contractual service margin as applicable. The second objective will be to enable the users to see how the premiums collected in the periods would reconcile to the revenue reported for the same period, and for linking premium collections and cash flows with the revenue presentation. This is covered under paragraph 79 of the 2013 exposure draft, and will link also back to the previous reconciliation to the extent that the balances have been moving in the period as a result of cash collection and payments. The third objective will be to explain how the revenue has been computed, and here the key elements of the disclosure will clearly be the linkage back to the release from the opening liability of the expected benefits payable in the period, the release as a result of the earning policy of the CSM being earned in the period as a result of the services being fulfilled, and the disaggregation from these amounts of the deposit components. That being all the key inputs that the insurance company would have needed to consider in order to reach the revenue figure. The final objective is enabling the users to understand the impact that new business would have had on the financials, and in particular, to use the words of the standard, what would be the impact of insurance contracts initially recognized in the period would have in all the amounts recognized in the statement of financial position, the balance sheets, in other words, to see how much new contractual service margin, new risk margin, or risk adjustment rather, and new expected cash flows have been added to the balance sheets since the start of the year. That would also give an indication of important comparative information for users when they will be able to see new business in the current year and compare it with the new business reported in the previous period. The benefits that the staff highlighted in their papers would come with the retention of these four disclosure requirements are associated with the explanation that insurance contract revenue would be having as a result of this, which would make it clear to the users and would also help them to bridge with past practices. It would also provide the volume information, albeit not in a prominent position in the financial statements, but still in an important footnote that should be drawn to the attention of investors in an appropriate manner. These set of disclosures would also help reconciling the contract balances in the financial statement, in the balance sheet, to the release of margins that are then contributing to the presentation of revenue in the statement of comprehensive income. In terms of the disadvantages, the staff quoted two groups of comments. The first one is the group of comments that came from a number of letters highlighting that the reconciliation between insurance contracts revenue and existing volume measures do not appear to be useful in the opinion of those commentators. The second group are the comments that came from letters indicated that the reconciliation explaining insurance contract revenue recognized for the period are also not necessary. Neither of these were considered valid concerns, and the staff was recommending to the board that the reconciliations presented in the paper and included in the 2013 special draft were actually addressing valid information needs of users. There was also a comment in terms of the disadvantages as to the cost that these disclosures will have. And the staff argued that the benefits highlighted earlier would outweigh the burden the insurance companies would have suffered in order to prepare these reconciliations. Having delivered this presentation, the debate started, and the staff started the debate by highlighting that the first two disclosures we saw earlier provided a reconciliation of revenue to cash inflows and disclosed the drivers of revenue, for example, the margin release on top of the expected level of expenses. And that was deemed to be a particularly useful bridge to past practices under existing IFRS and the new revenue presentation. The other disclosures would provide important additional information about the underwriting activity and the expected cash inflows and acquisition cost of insurance contracts that are initially recognized in the period. In that way, the staff wanted to argue that there was no dilution, no leakage of financial information and disclosure compared to what investors would receive from financial reports today. And everything would actually be better organized from a financial reporting perspective around this consistent format of disclosure. Another point that emerged in the debate is that these disclosure requirements are very similar to the one that were part of the 2010 exposure draft when the principle for presentation was around the summarized margin approach. And that again was an interesting point that the staff wanted to make, knowing that a number of board members were still of the view that the summarized margin might have been a superior way of presenting the performance of an insurance company. Finally, the debate also generated some queries around the usefulness of premium due as a key performance indicator of an insurer's activity, and the question as to why that indicator was not required for disclosure. The staff responded that at the moment